Good evening, everyone. I welcome each and everyone to this webcast on raising the fund through private equity or venture capital fund. I think today is the momentous occasion of the World Entrepreneur Day to recognize and celebrate the spirit of entrepreneurship and innovation. And we know that a lot of chartered accountants are being into the entrepreneurship, whether setting up a practice or whether setting up a unit or as a startup. I would like to take this opportunity to congratulate all my professionals who are entrepreneur and also wanted to be into this area of the entrepreneurship. I know that a lot of professionals, those are into the jobs, still looking at how we can start their entrepreneurial journey. And for them, I want to congratulate, and I also wish them happy World Entrepreneur Day. And I believe that this is the pandemic time, and in this pandemic time, entrepreneur must also ponder on the lesson learned during the ongoing pandemic situations. So once in a century, pandemic is really taught us the embrace of the new normal area, and for the first time in the human history, we are facing such kind of issues, and we have seen how the digital being a savior for each and everyone, how we are interacted each and everyone and communicated, and now seen the complete innovations being around in the technology, and we came to know about all the CAs or whether industries or everyone is scaling up a lot of innovations in this area. So now it's a part of the all chartered accountant has to be looked upon the various opportunities occur because of this pandemic, whether in the industry or whether it's practice or whether it's being entrepreneur. You have to think a scalable model and being innovative model. And once you scale up and having an innovative model, you need to figure out the ecosystem and where we get the fund. Once you have get the fund, and today is also the session where we are having how you can raise the fund through the venture capital. And once it's your model being successful and being the market, and second, then after is a P is going to be there. And today's completely session going to take up by the service. And being in this committee of MSME and startup, in the MSME side also, you require a P fund or venture capital fund. It's not only this is only for the startup; it's for also MSME also, and having innovative MSME, scalable MSME, e-commerce MSME, where the technological is also there, and a lot of people are taking the fund in the MSME. So this is the area for each and every, whether it's a startup or whether it's a MSME. So it's like a entrepreneurship. So entrepreneurship can be there in the scale up for the MSME as well as the startup. And in this committee, we already came out a ICAI web portal for the MSME. That's www.msme.ici.org, where we are providing MSME help desk, MSME exchange, certification course on MSME, and for now for the startup. Of course, on 26th of this August, we are launching our next certificate course on the startup, how to become an entrepreneur, and also launching our web portal, startup.ici.org, and where we are launching a certificate course on startup as well as the startup gateway, and where you can have a complete digitalization of idea pitching, investment pitching, and complete ecosystem of incubation center. We are going to launch 11 incubation center across India, and a lot of things are coming in this portal. Let's check it on 26th, and now it's a turn for this beautiful, conceptualized program by the service. And today we have a galaxy of the speaker, and the speakers from Vikram Gupta to the Vivek Chachi to the Gautam Bandyopadhyay, to the Nitin Lalpureji, all are the stalwarts on this area. One definitely entrepreneur, not a being as a startup, but see all the funding side from the startup as well as the private equity side, and entire session going to take the lead by none other than the service. Service is a chartered accountant and he's a successful investment banker and having experience in the private equity, merger, acquisition, takeover, structural finance, business and debt restructuring, and various emerging, taking up the terms in the emerging startups. So he's a chartered accountant as well as the in number of areas, MBA, a lot of things he has done it, and he's involved in the ICAI. I know him since last 50 years. Very prominent person into the startup ecosystem. Then I also welcome the Vikram Gupta ji. He is the managing partner of the IBCAP. I could say that a technological person, BTech from chemical engineering from IIT Delhi, and then MBA from the USA, and then got the several awards. And the latest one is beautiful award. You know, he got from the Rashtrapati, the President of India in 2019 for having he got this Alumnus Service Award from IIT Delhi in 2020. So basically setting up the India's first endowment fund at IIT Delhi. And that's the beauty which because he's a alumnus there in the IIT Delhi, and he set up the fund. And currently he's a managing partner of the IBCAP, which is a $200 million venture fund, which is investing in the IIT alumnus. So, sir, we CA alumnus is also there. Don't focus on the IIT alumnus. So, but he's already funded 30 companies, and he's a vast experience in all areas, whether M&A, business consulting, or all. So welcome to you, Vikramji, to this great firm of the ICAI Chartered Accountant, and we are eagerly wanted to listen your next venture, CA funds. Eagerly want to hear from you, which you are setting up. So now next is Vivek Chachi. He's a partner in the CX partner, and I could say that he's also a person from the commercial background. You know, I've seen his profile completely from the farmers, and completely from the farmer background, and then to the private equity and technology part of it. He served in the various companies, and last was I think he was also board of the Netco Pharma, and then he worked in the company called City Venture Capital International, and now he is working as a CIO and partner with the CX Advisor private equity firm, which is established in 2010, and which is focusing on mostly in the mid-market company in the healthcare, consumer, technology, financial services, and yes, they has the two funds, $750 million kind of funds they are managing it, and into the various pharma companies. So welcome Vivek Chachi to this ICA forum. Next we have Nitin Lalpureji. So he's also partner of Paragon Partners. So I welcome you, sir, to this ICA forum. You are also a graduate, and you are being a master's in chemistry from OU University, bachelor degree from the chemical engineering from the Mumbai University. You are the MBA IIM Ahmedabad, and one of the finest part is you are holding in your name more than 16 US patent. That's the amazing part of it. You also been from the pharma industries. You worked in the Cipla, and you worked in the lots of consulting company BCG, and you served into the US also, into the different company, and now you are the partner in the Paragon Partners from last 5 years since inception, and that Paragon partner investing the portfolio size from 50 crore to 100 crore rupees in the MSME startup. So it's a great area where the chartered accountant has to look out upon it, because this is the fund which is investing in the MSME also. So it's let's hear out from him, how the MSME can grow up and how the Prime Minister Modi vision of $3 trillion to $5 trillion economy going to increase in the MSME through the MSME, which is contributing about the 33% of the GDP as of now, as compared to the global benchmark of 60%. I hope that your investment will reach out to the GDP of contribution of the India's to the 60%. So India needs such kind of fund, more and more fund to invest in the MSME. So great, your fund one already have a AUM level of 760 crore rupees. Second fund is a AUM of 1,000 crore rupees. And with this, I welcome you to this ICAI forum, a great webinar. So welcoming you, Nitin Lakweji. Now we have, to congratulate, to celebrate a World Entrepreneur Day. And for this, we have the entrepreneur, Gautam Bandyopadhyay. So first of all, wishing you a entrepreneur day, sir. You are the successful entrepreneur, being worked in the Infosys, being worked in the various technological firms, and then in the various banks like Global Trust Bank, SDFC Bank, and heading the retail, corporate banking, worked in the Infosys in the 2001, and in 2009 we came out with a Finacle system. We all chartered accountants know the Finacle. We are all working auditing in the Finacle system. How the innovative Finacle system, everyone knows that. So a great contribution by you, and also Airtel Money, which you developed, which are the largest mobile operator wallet in India, which is a core platform. I think that's a core contribution which you have already given. And now you are the co-founder and head of the banking solution in Novopay. I think this is the one of the good part. That's Novopay is founded in 2014 and also invested by the Khosla Venture. And one of the active parties to all participants is that the Novopay has the more than 60,000 active outlets, and a GTV run rate is well over 12,000 rupees crore a year. So excellent, sir. So it's a SaaS-based services being offered to the bank, NBFC, fintechs. So great, and you got the award also, and best technology company of the fintech solution in 2020. So congratulations to you, sir, and welcoming you to the ICAI forum. So this all a complete galaxy of people who is going to deliver on the ultimate guide to the raise P venture capital fund to the startup as well as the MSME. The topic, though topic is not having the MSME. Now I'm seeing the Nitin Lakweji profile. Now I'm adding the SME. Hope that service will also include some of the MSME part, because entrepreneurship today is entrepreneurship day. So it's all about celebrating it, and all MSME can be a startup. All MSME startup can be MSME. So let's have it. Now I'm handing over this entire part to the service. I'm looking forward to your deliberations as well as the moderating entire session. So over to your service.
Yeah, thanks, Viraj. And it was really great to connect with you and our fellow chartered accountant members on the eve of the World Entrepreneurship Day. And appreciate quite the warm and welcome remarks put across by you for our esteemed guest today at our quite engaging panel. So first of all, to put the context that actually it's not only, when we see the investment world, it's more about everything is money, honey. So, whether it's MSME, whether it's startup, whatever is making sense, I think when we interact with day in, day out with funds, and and this thing is more predominant in equity, right? Because whatever is making good sense, it will see the innovative definition also of startupindia.gov.in. It's not just that somebody should have a patent or it should be a rocket science idea, but anything which can scale up, at a fast pace and generate good profits and good cash. That is actually something which all the stakeholders, maybe in private or public market, would love to have it. So, with that, actually, we don't, of course, restrict our thing to startup or MSME. It's every business and every entrepreneur to whom we can actually take into our purview. So, with that, I would just like to start this session. So, as we all know, the most crucial and the most aspirational thing that any founder wishes for is to have the fundraising round closed for his or her startup. So even the advisors, including chartered accountants and other professionals for startups, always wish the same for their clients who are in equity fundraising mode. So we all are privileged today to have with us some of the prominent personalities in the startup fundraising industry who will definitely enlighten us with their deep-rooted experience on ultimate guide to raise PEVC, startup and MSME capital. So as it's rightly quoted, that founding a startup itself is a pretty brave hard task. I mean, many times you'd say that starting is halfway done, but then raising money for your startup should be always said that it should be in your head instead of your heart. What I mean to say by saying that is that fundraising, even though quite dynamic, it is a scientific process altogether which is backed by well-proven and adapted theories, principles with facts and figures. Although sometimes people end up believing that luck was the predominant factor in closing a fundraise for any startup, but that's not altogether correct. And that's why we are, in this session for this discussion. So in today's session, we'll try to resolve all those issues which ought to be frequent deal breakers in fundraising, and yet there are contradictory views on most of these issues. So let us set firstly the context of the panel discussion for today. So the basic documents, as I told at the inception, was for any kind of fundraise from a venture capital or a private equity is an investor pitch deck backed by a comprehensive financial model. So when we talk for an investor pitch deck, the information to be covered in the pitch deck usually includes, it starts from a problem solution matrix, what kind of problem you are narrating and how you are resolving that problem. Then there is industry overview and the total market size. We call it TAM, total available market, and competitive landscape. Then there is the management team profiles, their background, where they are coming from. Then the startup journey so far, what they have achieved, MVP, prototype, anything. Then the business model surrounding around, their product offerings, the revenue model build, the unique selling propositions and their marquee customers, and the growth strategies and the future roadmap. And it ends up with the fund requirement, what kind of check they are looking to get from the funds or equity stakeholders, and where those funds will be going to be deployed into broad heads. So these are actually, the major content of any pitch deck. Of course, it changes from startup to startup because it's quite dynamic because every business is different. So today in our discussion, we'll move around the coverage and the expectations of PEVC funds in each of these aspects. To make it more engaging, we have an inclusive panel today with PE fund managers as Vivek and Nitin, venture capital fund manager, one of the top fund ICAI managing partner Vikram, and we have actually a startup founder Gautam who had successfully raised his couple of funding rounds so far. So starting with a good round of applause for all our panelists, dignitaries on the dais, backed by a learned audience, we'll try to make out the most of today's available time through our panel discussion. So, just kickstarting with you, Vikram. So just, being a founder and managing partner of ICAI Ventures, you and your team might be witnessing hundreds of pitch decks day in, day out. So as we know from the investor's point of view, seed and Series A funding are the riskiest bets as there is still no profit in sight in most of the cases. They are EBITDA negatives, and there is actually every chance of the business getting failed. So when a startup or its advisor or a banker approaches any angel or VC and presents its investor pitch deck, then the first slide that pops up is the problem solution matrix. That very slide, many times funds make decision that whether it's worth giving a shot or not. So around what all parameters you judge the problem solution matrix in any startup?
Sorry, my internet was a little unstable, so I only could hear part of your question, but I think I understand the question in general, what you're asking. So I'll tell you broadly, first of all, I think it's important to understand at what stage we invest, right? So we are typically the first institutional check, and which means that entrepreneurs would have either raised no capital before they reach out to us, or they may have raised angel money to some extent, or sometimes even pre-Series A capital. So they come to us to primarily raise Series A capital. Typically, we invest in the range of, if it's very early, we even invest 1 crore. If it is a Series A investment, and sometimes we also take Series B bets very selectively, and our range of funding could go up to 50 crores. So that's the range of investment. So I think at that stage, when we are looking to invest in entrepreneurs, we are, I think you gave a very good bigger picture of what goes into a pitch deck, and of course, all those things are very important. We typically like to start looking at a document that they put together. If we haven't met them before or don't know them from any other connect, if they just reach out to us on their own, the best way to know them is how they put their pitch deck together. That brings out their level of maturity and professionalism and their structured thinking, clarity of thoughts. Also, so how they put their document together also brings up the level of maturity the entrepreneurs have. But within the document, there are certain things which are extremely important from our perspective. One, we obviously spend time understanding the team. And I think I would say that, of course, team and the problem they're solving are the two key components of understanding what we are looking at. Problem they're solving is obviously multiple factors, including the sector they are in, within that the segments they're targeting, the size of the market they're looking at, the competition out there, and of course, therefore, is this the right business model? Is this capital efficient? How much capital they will need to scale this up? So lots of those things come up, but the team actually is very critical from the perspective of the execution ability, the ability to raise follow-on funds, their ability to work together. It's very important to understand if it's a team of 3-4 people in the core founding team, we need to make sure that they can work together very well. And also, how they thought through all the scenarios. They're obviously, when things are going well, everybody's happy. We also need to understand whether they've applied their mind to a situation when things don't go well. How are they actually thinking of those scenarios? So it's an engagement process. Typically, in our case, we like to engage with entrepreneurs over a period of time. We just don't look at the pitch deck and then have a meeting and then decide for investment. It's typically a longer engagement cycle. So we like to know people, because ultimately it's investing in people and partnering with them over a period of time. So we would like to make sure that we are partnering with the right people. So it's we are very focused investors. We are not like a spray and pray kind of investors where we will invest in 100 companies and then go to the temple and pray. We would want to work very closely with these people, bring a lot of value add, mentorship, guidance. So therefore, I think it's a process rather than just a kind of a transaction for us. So that's how we look at things.
That's I mean, the two takeaways what I could take is quite right. One is actually, as what Mr. Albert Einstein have said, that in 60 minutes time, if you have 55 minutes, you should put on the problem. I mean, how big is the problem, and 5 minutes for solution. And I could see you are also telling more of the identification of the problem rather than resolving it. But many times, if problem is not good, then solution is not applicable. So that's quite good. And other point I have planned to cover at later part, but since you have actually told it, that's quite beautiful. And what I also see that one of the major reason many times for not getting these startups successfully take off is the internal fights between the views or mismanagement between the founding team also. So that is one thing you told, that togetherness of the team, how far actually they have been working in their past engagements. That is actually something quite crucial to be looked at. Sometimes we are skeptical. I mean, this is one of the question also we get from many clients and audience. So just if Nitin, if you can address that. So many times what happens that to get this mismanagement or other issues resolved, you also look to have a founder's internal agreement in place that what will be the role, responsibility, and will be bringing how much of cash infusion, bootstrapping into the startup, or something actually formalized between them? Or do you judge between, when you, interact with them, how it is that you move around this very aspect of getting, a good wavelength is existing or not between the founders?
So just before I start, let me give you a bit of a context on Paragon Partners. I think you've given a good introduction which covers most points, but we are an Indian private equity fund focused on investing in MSME companies, and we really look for high caliber founder and management team that can grow the business faster than the industry, even somewhat faster than the industry over the 4 to 5 period, right? And we are long-term patient investors. And apart from capital, our team comprises of people with operating experience like myself and entrepreneurial experience. So we work alongside the entrepreneurs and the management team quite a bit to help them grow faster. So in some ways, we are an active fund manager. We don't run things day to day, but we are in really active touch with our founders and resolve issues and take decisions very quickly, rather than have a very structured relationship, board meeting to board meeting. That's not who we are. We are on our founders' WhatsApp every few days or every day in many cases, right? So we are very intimate with our founders in some ways. Overall, I agree with Vikram, right? I think a founder and the management team is the primary attraction for an investor. And that is one most important aspect when we look at our companies as well. When we look at business models or pitch decks and do the first couple of meetings, those meetings are the most important to assess the founders and the management team, the quality, the way they have thought through different scenarios, the way they're articulating the scenarios and how the team is structured around them. The organization structuring is significantly important. So coming to the question you asked, the founder dynamic is very important, especially in a multi-founder kind of a scenario where there are multiple co-founders in a company. You have to have very clear roles and responsibilities among the founders. And those are things we would discuss up front. As soon as we like the company, we like the people and overall business model as well, we will sit down and have a very frank chat between what is the relationship, how do you guys come together, who does what roles and responsibility, what happens in case of a conflict, right? So that is something we need to spell it out, and that is part of our agreement, believe it or not, right? That there's 3 co-founders, but they don't get equal weightage. If there is a conflict, this guy is a key decision maker, right? So then you're basically in some ways incorporating those in part of the agreement, where you know who you're backing in some ways as a founder, right? So that tries to eliminate most of these issues. Of course, we are a very young fund, so we have a lot to learn, and experience will teach us more. But overall, the agreement is very important. I think first agreement is more of just understanding the individual side, the human side of the relationships and the interplay. And we like to spend a lot of time with our founders and management team to understand that and really understand the human side of it. But from our fiduciary responsibility of looking at the business, making sure that this business doesn't suffer because of founder dynamics. We incorporate some parts of roles and responsibilities, and most importantly, conflict addressal in part of the agreement.
That's quite really good to know, because we see that many times actually many investments have been made where conflict resolution was not in place, and then actually all these stakeholders have gone for a toss, and it's great that due to the learnings of those startups, now actually these things have come in place. So I think founders actually should also be getting tuned before approaching to the funds, that how and who will be leading in case of conflict and what will be the resolution. So at least the show must go on, as what Mr. Yash Chopra has sometimes told. So that's quite good. So Vivek, again coming on to you and extending this very thing on the management team, because this one of my last question, which is again a quite contradictory or quite confusing kind of views people around, professionals around really have on this. We'll cover the entire, I think, thing of the management team before moving out to other head. So I would just, like to ask you that many fund houses prefer to fund the startups only whose founders are qualified from premier institutions like IITs and IIMs, or having a strong work ethic from premier corporations. If you'll see, some actually funds also mention it explicitly on their website or their investment strategy or philosophy, that okay, if you are from premier institutes, from a Ivy League or from actually IIT IIMs, then only will be considering your startups. So, but of course, we also see that many successful startups have this kind of background only. But then there are actually exceptions are always there in the startup world, and we can see Ritesh Agarwal like people building Oyo rooms, or some good examples you better know. So if you can put a comment, because some people say that is it not a hardship on some founders who are really backing up with a good idea, they have a good scale in business, and why they should be deprived of getting access to funds if they would have unfortunately not studied at those institutions. So just before addressing that, like Miten, if you can just brief a little investment philosophy and what exactly CX Partners do, and then if you can address this, it'll be great.
Certainly. Thank you, Sarvesh. So, briefly about what we do at CX is we are typically more later stage investors. So I would say that 60% of our capital is in situations where we have, as a fund, a majority in the company, in the business. These are still medium-sized businesses with revenues of maybe 200 crores to 500 crores in our 4 sectors. So we take board control and work with the management team to take the business to the next level and the business has already been set up by the founders. And about 40% of our capital is in minority situations where we are active investors, and new age businesses and the kind of businesses which we are speaking about right now, we have just begun to invest. So we are learning that space. On your specific question, Sarvesh, clearly, let's just step back. The way I look at it is that end of the day, all investors are in to make money. And how do we make money with equity? It is when we back a great leader in a good business, solving a great problem, who can grow and grow with his customers and motivate an exceptional team and create a great culture. Does that have to come from somebody who's been to IIT, IIM, and Harvard? No, not necessarily at all. So the real fundamental is how does the fund house spot great quality, great intellect, great integrity, and great leadership? That's what normally a fund house is looking for. a lot of people who become chartered accountants or who go to IIM Ahmedabad or who go to Harvard have a lot of those qualities. So they will all be, so if you're a chartered accountant, obviously you are very, very intelligent. B, you are very, very gritty. That's something which we look for, which is basically how do you solve problems constantly, take failures, etc. Not everybody who goes to IIM is necessarily a great leader. So these are the problems. What we're looking for is a great leader who can think through problems, lead a great team, and serve the market well. If we as a fund house begin to say that, let me not think about this myself and just go back and shortlist the candidates by what a CAT exam did 10 years ago, 50, then we are basically not doing our work fully. We are outsourcing our work to the examiners of the CAT exam or the JEE exam or the CA exam. So there is a high degree of correlation of successful businesses with people who had great education, but more of our businesses have people who, all our businesses which are successful necessarily have people who are very intelligent, who are very, very energetic, and who are great leaders. And a lot of people who have all of that did not go to IIM. So so there is no bias. There could be a bias. If there's a bias, then that's the shortfall of the investment firm.
That's really quite well said, and I think a perfect resolution to this question. So Gautam, actually just on the management team will wrap up with you, and you have actually 3 judges over here, and because always the funds and the investors who sign the check, they actually are on the judging chair, and you being the founder alone, and when we see that these are the people who actually are standing out of the swimming tank, founder is the one who is actually swimming. So, you might have sailed this journey through, you might have actually, build your team, your co-founding team, and led the startup. So something on your journey at a little bit about Novopay and your journey at Novopay, how it started and how really you get building a successful founding team.
Yeah, thank you, Sarvesh, for the introduction. I know, it's been what I heard from Vikram and also from Nitin and Vivek. I think this is all sounds deja vu. This is exactly what when not just when we pitch, but when we actually form a team. Okay, now you would be looking for a team being formed with which can bring complementary skill sets. Okay, and and exactly the point that when everything goes well, it's all fine. But every startup, I can tell you that they will go through the ups and downs, and there'll be a point in time where you'll almost think that the business is going to close. But how do you fight that, and how do you come back from there? It is a very, very largely determined by the qualities about the people that have started this journey together, and subsequently what you hire as a part of the management team. So its founder and the management team is an extremely critical part, and that's where even when we when I talk about Novopay, way back in 2013 when the Aadhaar, my co-founder was the head of technology of Aadhaar, and I have met him through a common connection. Basically, I was in Infosys. Nandan spotted me doing certain things very innovative, and he introduced me to Shrikant. We came together, and then and at that point in time, what really happened is that we saw that Aadhaar was being adopted in a massive way. Okay, in 2013, it was 650 million Aadhaar. Aadhaar was already there. Right now, of course, it's 1.2, 1.3 billion. Then we also saw that the retail stores. Okay, that's something that somehow, even though there was commerce which was getting more organized, commerce was there, e-commerce was thriving, or it was booming. Even then, the retail stores were actually not dying. Okay, and India is a traders nation, and we at that point in time there was some 13 million retail stores. The retail density of India was the highest amongst the world. Okay, enough higher than China and any other country as well. So, so that was one more thing, and they were having an existential issue, in terms of how do they fight, the e-commerce wave, and how do they, stay relevant to the customers who are, in and around them. So that was the second thing, and the third thing that we saw is that Android phone, okay, I mean a smartphone in general, but Android phone was being adopted very, very fast pace. I think that about 200 million plus Android phone users, okay, unique users were already there, and the retail segment, specifically the the mobility segment of the mobile phone recharge distributors and all that, they already knew that market. They were adopting to this technology very, very fast. So we saw these three things coming together, and the whole thing, and being the conduit for distribution of financial digital products across India. Okay, so that's what we saw as an opportunity. When the team, so Shrikant was in Aadhaar, he knew in terms of, and Aadhaar has gone all the way in terms of bringing many protocols such as AEPS and DBT and so on and so forth, which are financial protocols, which came in along with Aadhaar, and that is what made the adoption of Aadhaar so successful. I had come from product and technology background, focused on digital product, digital distribution of the product, and digital lending, and digital payments, and so on and so forth. Okay, so that was a complementary skill. Then we had our other co-founders who came from a retail, understanding retail really well. Okay, so all of these things put together. So that's what really made Novopay for us to really understand in terms of what the market can offer, what can we really go and do. That became possible because we really came to come together as people bringing complementary skill sets. Okay, so that was so today, of course, Novopay, 7 years down the line, we are a profitable startup. We have been moving about 1,000 crores plus in a volume GTV across our retail network. We are in 500 plus districts, about 12,000 pin codes, 23 states, that we cover. So there's a significant reach that we have built an asset which is a very good distribution. It gives us a huge distribution reach. And on the other side, we also built an entire technology platform, because when we realized that integrating with the banks was the hardest part of our product offering itself, because the technology piece on the other side was really not up to the mark. So we decided that we will build up the entire tech piece, and we went to the banks and offered them our technology so that it makes our journey easier, okay, in terms of integrating with them. And then that becomes a SaaS solution business in itself, okay, at a later point in time, contributing approximately 50% of our entire revenue per se. So that's what we do as Novopay, okay. And absolutely right, in terms of the getting complementary skill set, management team working together with a clearly defined responsibilities is an absolute must for any startup to succeed. Sarvesh, you are on mute.
Sorry. Oh, so that's commendable, your journey to listen your journey at Novopay, and complementary skills not only from the point of view of getting good roles and responsibility segregated, but it's also important because at initial years of the startup journey, you don't have that much cash to burn on a significant kind of salaries which you might end up paying to the senior management team. So that's also important, that you should actually have a CTO also and a chief product manager also. And as you said that your thing is more on retail side, so you have the tycoons who have worked in that. So that's quite good. So I think we have actually quite well covered on the management aspects, and the views of everyone were quite good and diversified. So just let's move on the next thing. And as chartered accountants, you know that we are called as more Munims kind of people since the olden era, and the fraternity of chartered. Of course, there are actually a mixed kind of audience we have got in this forum, but predominantly chartered accountants. So we know more of number crunching. And many times we make, financial projections or model day in, day out. But of course, there is a quite bit difference of making a financial model for getting a term loan or a working capital from a bank and getting actually, an equity from a fund house. And there are varied aspects which need to be covered when I have seen, because coming from a debt side for 7 to 8 years, then to the equity side since 5, 6 years, I have seen a paradigm change in the kind of expectations and the aspiration of the investors. So now, whether it's debt or equity, any financial projection, if you look out, that will be actually looking amazing. 10 on 10 business or startups, MSME, anything, that will look amazing, that you will be achieving the world of the world in coming 5 years. No one will give, a back picture. So Vikram, actually, as you told that, you are the first in the league, because at least when it comes to Nitin or Vivek, they have actually certain kind of background that, okay, what they have performed in the past. But in your case, it's more of raw, because sometimes you also take a daring of writing that first or second institutional checks. So what exactly really you get at what we call in our common parlance the traction? So what is the traction you judge where those numbers are coming? It's quite a wide question, but then ultimately that is the deal maker or breaker.
Yeah, so I think you hit a very important point, Sarvesh. I think, typically what we are looking for also is some unique business, right? So somebody who is actually addressing a problem which has not been addressed properly, right? So, and in that situation, it becomes also hard to judge at that stage of the business whether this is actually the right solution, right? So, and the solution, obviously, they come with a lot of claim that this is the solution which will work very well, and this will scale, and this will become a unicorn. So all those kind of claims come at that stage, right? So therefore, the level of effort required is actually much harder typically at that stage, where you have to actually do a lot of market research to validate some of their claims. And the best validation happens through their existing customers or their potential customers that they claim that they will be their customers. So you just have to pick up the phone or go and meet them and understand how are they solving their problem right now, and if this company didn't exist, will it really make a difference? And I think a lot of answers you get by talking to those customers or potential customers, validating the potential solution being offered. And it's also a process. Typically when you do that research, during that process, you also realize many times that even entrepreneurs sometimes may not have necessarily covered everything. So in the process, we as investors are also able to sometimes figure out maybe some other ideas at that stage, which we are happy to share with them and also give them some inputs on that. And in the process, they are able to also get a lot more learning from that experience. But then, while you can do all that in terms of validation of the product market fit and understanding of the scalability aspect and the unit economics, and are the margins good enough for them to really then be able to scale this business, so there's a lot of detailed analysis that happens. But then it goes back to that original aspect of, the business model will evolve, right? So and the markets change, the dynamics change, the market size changes, the competition changes all the time. They may not even have thought about certain competition, which has actually just got funded somewhere and nobody's aware of that. So things change dynamically. So therefore, it boils down to people, how smart they are, how nimble they are, how street smart they are. Can they take challenges? And typically, while I agree with what Vivek said earlier, that, obviously you will not only go after people with certain educational backgrounds. But it's very interesting, of course, Ivy Cap doesn't say that we will only invest in IITians or IIM graduates. I think it's a deal sourcing strategy, basically. We actually, when it comes to an IITian or an IIM graduate approaching us, we give a lot of attention to them. Irrespective of whether they are at whatever stage they are, we actually spend time with them because we created an ecosystem around that. Our portfolio has a large number of alumni founders, but that doesn't mean that we don't have non-alumni founders in our portfolio. But it's very interesting. Look at 61 unicorns in this country today. 42 of them are founded by IIT IM alumni, right? 770 unicorns globally. Rank them by the background of the founders. The IITian founded unicorns would rank number 4th globally. Now, I think there is something, and even if you look at our portfolio, and this is not something we actually built thinking like that, our top 3 companies are IIT Delhi founders. So I think it's not something that we gave preference to those founders or something. It's just that there is something which actually goes into the certain kind of mindset, certain kind of discipline, certain kind of objective orientation, certain kind of team building skills. That comes with certain kind of preparation and backgrounds. So therefore, I think these things make a huge difference. But that doesn't mean that you won't find. You gave example of Ritesh. We have FingPay as a founder of our, it's non-IIT, non-IIM, has done exceptionally well and much better than anybody else in the portfolio. In that sense, it's still early days in that sense, but you can find entrepreneurs, excellent entrepreneurs otherwise as well. But I think there is a strategy that works for different strategies for different people, but that's the approach that we follow.
Great. I mean, that's really quite good to hear. And many times we see prototype or MVP, minimum viable product, only on the technology front we used to judge. But now actually nowadays, I think what you said, if I'm putting it correct, that MVP need to be done in a business development aspect also. That actually, what kind of revenue you are generating and really what kind of burn you are making for that. What kind of cash positive negative is coming, and then you can replicate the same on the period by period model. So there is to be some base which we are giving to that projections, like not hanging it completely in the air and having nothing to judge. Coming on to you, Nitin, with the projections, there are varied financial ratios. That also dynamically differs from startup to startup. But one of the favorite thing what I usually we have in interaction is CAC by LTV. So customer acquisition cost plus many times what is startups in their initial phases are getting EBITDA negative, and then you have to see what their competitors are getting the customer acquisition cost per customer and what is the lifetime value attached by getting that customer. So, I would say that, if you can relate something, and if there is no actually, whatever you can relieve or discuss in the public domain. So you have quite a couple of beautiful startups, like one of them I always admire is Chai Point. So, in the world of Starbucks and CCD, when people are not getting actually a real milk tea or coffee to drink, you actually really made Chai Point a quite big story, and not only affordable, but then quite tasting according to the taste buds of the public in India. So, taking Chai Point or any other startup, if you can just give a glimpse on what exactly you look on a CAC to LTV ratio or other things in the financial ratio moving around for judging the scale better.
I'm happy to hear your thoughts on Chai Point, and always proud of it as well. But just taking a step back, obviously financial metrics and some of these numbers are very important, as you understand and appreciate. However, the most sort of important thing for us is to start with the business itself, right? And what is the business strategy? What is the business model? What are you trying to solve for? What is the solution that you're proposing? How will the competition look at your moves? How will the other ecosystem around you change? I think And those things are very, very important, and we need to get those comfort as well way early in the process for us to move forward. Obviously, as we move forward with a transaction and we like the management team, the founder, we like the vision, we think there is ambition, there is grit in the founder, and there is sort of ability to get things done. Those kind of things, once we have good comfort on, and we then move to sort of financial numbers and metrics and try to see what makes sense and where. Of course, CAC, LTV, those metrics are very important for consumer-oriented businesses. Half of our portfolio is consumer as of today, not by choice, but that's how it progressed. And we look at other sectors as well. In terms of looking at metrics, really the first metric that is most important as a growth equity investor is the growth itself. Right, so you can have excellent LTV, excellent CAC, but if you're not growing, then that's not exciting enough for us, right? So one is how fast can you grow the business, and that's really the objective of a founder to come to a private equity fund, especially a fund who can work with them and help them grow faster. If you have a company which is growing at 40, 50% year on year over a long term, then those companies end up being winner, and all the other financial metrics take care of itself, right? Because you would have found it viable at a certain scale. We come into companies at, let's say, 100 to 300 crore kind of a revenue range, if you ask broadly. And if those metrics and gross margins are fine, your organization is well set up, so your corporate costs are sort of mainly baked in. And if you're growing at a good sort of revenue base, everything else in some ways takes care of itself. However, those metrics get important as you scale as well, and the metrics tend to be quite dynamic because some of these metrics are not in your control. Today, Facebook or Instagram changes some algorithm in their search and their digital marketing domain, and your CACs can just go through the roof. And this is not something that a founder or a management team can control. I've always believed that marketing or growth hacking, as it's now called nowadays, has to be multi-pronged. You can't rely on one channel of digital marketing and just keep buying revenue. You have to build a brand as you go forward so that you are in the minds of the consumer, in the minds of your customer, so that when you think of something, automatically you think of the company and the brand itself, right? So when I think of Chai Point comes to my mind. There's nothing else that comes to my mind which is even close, right? So that's how a company should look at building their brand and growing the company. And similarly, there are other channels now which are becoming quite important, like influencer marketing, also digital hoardings, advertising on OTT platform. So what I'm trying to get at is, while CAC, LTV, those things can be manipulated in some ways or misused in some ways, always focus on the business model itself. And when you're spending money on marketing, don't lose sight of building the brand itself. It's always easy, and for someone who's not a founder, who's not a marketing mindset founder, to keep spending money in Facebook or Instagram and keep getting new customers. But it will backfire if you've not built a brand and you're just basically buying revenues. So I would think that those aspects get often ignored by some young startups, and they should focus on that as well.
So, I mean, with Vikram and with you, one thing is sure, what I get into this is that if we treat CAC as a pen, then whether it may be a Renault or a Parker, it is more important. Are you clearing the exam, writing the paper out of it? So,
correct answer is more important.
I think that is the ultimate thing. So coming on to you, Vivek, as you told that actually you have recently started doing investments in small companies, or otherwise you do mid-size more, and say minimum actually 200 crore Indian rupees plus kind of sales. So say suppose a company is 250-300 crores current annual revenue rate, and what kind of because growth is again quite a subjective thing. So in that stage, what kind of growth you would like to look in coming actually 3 to 5 years, to consider that MSME or startup to be a good fit for CX partners?
So, Sarvesh, that's like asking how much money do you want to make? Obviously, the faster the better. But realistically speaking, the way we approach growth is we only focus on 4 areas which we constantly research, one of which is healthcare, one is technology, products and services, software, one is consumer, and one is financial services. So in a healthcare business, I would expect, I would be more satisfied with let's say a 20% or a 25% CAGR growth rate. Whereas a consumer business or a financial services business should be growing faster, and a technology business, if it's a product business, should be, depending on what stage it is, should be going much faster. A technology services business could be, if it's growing at, again, 25%, very satisfactory. But it also depends upon the situation, the company, but these are just benchmarks. Also the quality of growth. Are you using, is there operating leverage coming in? Are you using less capital for that growth? Is the domain product knowledge or the brand, which Nitin was referring to, is it coming into play, etc. So just for instance, we have 3 restaurant businesses or have had, and one was when we first invested in Barbecue Nation about 10 years ago. At that point in time, our expectation was that there will be perhaps 40 or 50 Barbecue Nations across the country. And that was the market sizing which we did. And every 18 months, the team would go back and say that this can grow more. And of course, the company is public now, but with a market cap of over 4,000 crores. And our last expectation was that they could possibly go to 400 stores. So it's a question of the customer evolves, the product has more legs, but of course the financial metrics are always important to look at. What cost are you getting that growth?
Yeah, so I mean that's good, great to sum up the whole thing. That actually, while taking an equity fundraise, I would urge to chartered accountants fraternity that just not actually it's a pull and drag of the Excel, but actually you need to study the competitive landscape, the companies at what scale they are, other competitive companies are growing, and what kind of different, past experiences the startup has already in place. And so whatever growth and whatever projections you are putting in, there's handful of mindset that need to be applied. And as Vikram said in its initial narration, that it's correct that how far you are prepared before you actually present it to the funds that actually showcase your seriousness about your own business. That's quite good. And of course, great congratulations for Barbecue Nation, because we have actually chai also and Barbecue Nation also at place, and it had really been a great disruption in the whole restaurant industry. And that is something people always like to try when they want to try something different than a routine buffet. So that's really a great investment. Moving on to the next, Gautam, with your experience again, I mean, many of us have heard, sometimes Vinny Bansal also saying publicly that, in case of Flipkart, one of the mistakes they have done is by diluting more amount of equity in their initial rounds of funding. So had Flipkart founders kept in mind the value of business in the 9th year, they could have probably withheld a much stake for themselves at the time of strategic acquisition by Walmart. So, how as a founder of, say, one of the highly successful startup, Novopay, you gauge or arrive at the fund requirement in your initial rounds of funding versus equity dilution? Because again, both goes hand in hand. You need actually certain amount of funds. Don't want to settle for less because that's required minimum for growth. But at the same time, actually, the funds are more demanding because as Vivek correctly mentioned that even the founder, even the funds are there to make money. So how have you handled? Sometimes it might have come in your way also. So if you can just with your couple of fundraising rounds gone earlier, with due respects to your investors, if you can share a little bit.
Yeah, sure. I think, Sarvesh, see, the question really is that, do you have enough to have your founders and the management team, motivated to continue to put their efforts, and do they see, an outcome out of this, right? Okay, so you can, would you have the quintessential question that we need to ask, that do you want a bigger pie, a bigger share of a smaller pie, or are you okay with a smaller share of a bigger pie, right? So, at the end of the day, when you're on mute, if you're saying something, Suresh. Okay, yeah. So the end of the day, our journey has been a little different, because our journey has been, from an incubation, perspective. So we got incubated under Khosla Labs. Okay, so that was an incubation center, and that is how we have evolved. So essentially, when we do that, it's not really like when we are deciding as to how much to dilute, and so we have all an agreed template that was there, beforehand. Okay, without getting into the details per se, that there was a template that was already in place, and we had worked according to that template. It just suffices to say that in that template we had kept enough for the founders, and also not just the founders, but a good amount of pool that we decided that we'll be keeping it for our ESOP. That's good. So, we pride in being one of the companies that every one of our employees, they are given ESOP when they join, right? So they get a stake in the company, and they have that, continued interest in terms of that share of the company becoming a very large value generator. Okay, so this is where, let's say, from my own background of having worked in Infosys, and Infosys was like a fairy tale story for as to how people made a lot of money, and they became millionaire out of that's the first early startup that NRN started. And many people were, there are stories like even the peon of the office was having large number of ESOPs, and then he became a crorepati, or he became a lakpati, could buy good houses and cars and so on and so forth. Okay, so that's something that is really inspiring, in the sense that you need to have not just for the employees and the founders itself, but also a very large pool that we have kept consciously to attract talent, so that we can keep replenishing in terms of whatever that we need as we grow in the business. So there's always from a low scale to 1x to 10x and 10x to 100x, and there are such large decision change and strategy change, and people, fresh blood infusion, all of that is required when you get to those that journey, and therefore there has to be enough for everyone to to participate. So and without getting into the specifics in terms of the percentages and things like that, okay, so there are people say, I think probably the VC and the PE, my colleagues out there, or the co-panelists out there will be able to give better data on that. However, I think it's very important to us. What it means, that what was important is that there should be enough, for, let's say, an incubator to back us and back with the idea, and ensure that we need the necessary funds in the early stages where we are piloting the concept, when we are still understanding in terms of what are the moving pieces, and we have enough funds not to run out of money. Okay, and yet we have enough stake in terms of growing this business, and therefore it becoming significant for each one of us as the company grows, and a significant pool which is kept for the employees who will join as to be given as ESOP, so that we can keep attracting talent and make sure that the company grows from strength to strength. So that would be my take on the
Got it. So Vikram, coming on to this thing, see, many times actually one of the things which is crucial for chartered accountants or investment bankers is for the founders themselves, that what kind of fund they should raise, because there's actually, of course, our cash model, cash statement, what they used to prepare. So is it actually 12 months or 18 months or 24 months? And suppose actually somebody comes with 18 months of burn, and say they are trying to raise a check of $3 million, around about 22 crores. How do you really judge that? Because underfinancing and overfinancing both have their own disadvantages. So in terms of number of months or burn rate, or is there other parameters you judge on those aspects, and how do you really arrive on that? And is there actually we can see certain funds like Bloom Ventures, they have actually been earlier written on their website that they'll actually take a 15 to 20% kind of stake, whatever valuation that is, that's static. And some funds actually move around with the valuation multiples at venture space also. So what is your take on the fund need to be raised, and what kind of valuation moving around?
Yeah, so I think this is actually dependent on lots of factors. And the first and the foremost is that, you should plan your fundraising properly, because you can't assume that, you have 3 months of capital left, and then you need to start raising your capital, and then, you run out of cash. Situations can go bad. I think people who were starting their fundraise process in the month of February last year, and if they were left with just 6 months of cash at that time, they wouldn't have anticipated that April their revenues will go down to zero, while their costs will continue to remain the same, right? So situations can happen. So you have to make sure that, as you said, typically there is enough capital available with you to survive for at least 1.5 years or so. And you start the process by not starting the pitching to the investors at that time. You start with the more of a relationship building process around that time. You basically just talk to the people, and maybe start connecting with investors, get their feedback. In fact, I've realized the more you talk to the investors, the more you are able to learn in terms of, how to even, make corrections in your business if required. And entrepreneurs who understand this game well, they are able to really do a very good job even in their businesses. And what I've seen in the, entrepreneurs are really smart. And Miko, interestingly, we put in our money in the month of April this year. Interestingly, they just closed another round of, they were going to the market for just raising about $15 million. They actually closed $28 million in the month of last month, actually. So this is like, the market can surprise you on both the sides, right? Sometimes you are planning to raise smaller capital, and then the question is harder on both the sides as well, right? So typically what happens is that when you're negotiating with the investors, you're actually only out in the market to raise 15 million. And then a lot more investors start coming to you and say, hey, we want to put more money. The question that you need to ask yourself is that, do you really need that amount of capital? Or if you have that amount of capital at this stage, does that mean that you would be able to do things which you may not have planned in your business plan? So that those questions start popping up, and is this going to add to your overall value? In fact, these days with so much liquidity in the market, it's this thing which is happening right now. We are seeing people are going to the market for a smaller raise, but ending up with a much larger raise. And it kind of comes down to, if you met lots of investors, in your overall preparation, and people know what your business model is, the team, people already know the broader pieces of it. And when they see that point of inflection that, yes, this is the perfect timing to invest in this team, then lots of people start coming together, at the same time. And that's when it becomes extremely hard for entrepreneurs. And I can tell you that I have seen majority of the cases where entrepreneurs end up taking more capital than required. It has worked against them as well in the past. We've seen examples of various other companies where I think we've seen the era when there were ShopClues and Jabong kind of companies where there was this entire thing towards somehow reach the $1 billion valuations, right? So I think that era is gone. Entrepreneurs have become much more mature in general. I've seen personally the maturity levels in terms of how to use capital, how to really build businesses. Given those maturity levels, I think a little bit of extra capital raising is actually going to help people. But if that amount is quite substantially large, then it becomes it impacts human psychology, right? So you somehow start thinking how to spend the money, and you end up actually burning more capital. So I think there's a balance one needs to arrive at.
Vikram, actually, when I asked you initially the problem solution metrics when we started this conversation, so I was, and then now also moving around to this question. So if you can present your experience a little bit, moving around any of your good portfolio company, like one which I admire the most is the Purple. So Purple actually, again at the times when you invested, because it was a sector-specific e-commerce, and people were quite skeptical that in the world of Amazon and Flipkart, all giants, will this sector-specific like Hopscotch or FirstCry or Purple, these will figure out or not? But that came out quite good. And if you can just sum up all these what you have said in whatever you can share moving around, so that will be good case study.
No, you're absolutely right. At the time when we were looking at Purple, there was Nykaa in the market, which was far ahead at that time. There were question marks around. There was Amazon, there was Myntra, there were quite a few others who were in the similar business. And then very fundamental question, is there a space for another player in the market? And by the way, there were investors who were actually saying that, no, we can't invest in this, especially because we don't know whether there is room for more than one or two players in the market, right? So it becomes a very fundamental question. So I think we approached this from a very different perspective. We looked at this overall beauty and personal care market. It was about $30 billion, with online being just less than a percentage, right? At that time, we knew that the overall, the transition was going to happen from offline to online. And if that was going to happen, the people who are going to gain the most are going to be ones who establish themselves in the online world much better. And therefore, it mattered a lot if you really utilize the technology, if you're actually approaching this through a technology product rather than what you're selling on the platform itself, right? So these two entrepreneurs, again, young IITians, had absolutely no understanding of the beauty industry otherwise. But knew what approaching a consumer market means in terms of understanding the persona, building the persona, customizing approach, and creating a pull factor rather than a push approach. Rather than an inventory-driven model, can we actually segment the market through technology? That approach itself made a lot of sense, and I think, to be honest, we did expect that we'll do very well, but we were not expecting that we'll end up with a 22x kind of a return with the 15 crore investment at that time. Even now you can see it, how, while Nykaa has obviously done extremely well, but we had the opportunity to invest in Nykaa when we were actually looking at Purple at that time. And, we clearly compared the two. And while Nykaa could have looked very good on our portfolio, but it wouldn't have given us a 22x given the valuation they were asking, given the model and the capital they've consumed post that, as compared to Purple. So capital efficiency becomes very important. Your overall thinking in terms of how you're going to really approach your customer and create a viral effect or multiplier effect on your capital. So I think all these things actually really worked for us.
Got it. Coming on to you, Nitin, actually, many times now there are actually two school of thoughts when you structure the investment, because structuring the investments are too important for chartered accountants or bankers. So, one is taking a plain, equity, or many times actually you see that founders claim that they'll be performing really good, and you also want them to achieve that. So, there is a format of, say, compulsory convertible preference share, CCPS, what we call, at a later date, at a pre-decided valuation method. So, what is, more a preferred form of investment? Is it to finalize the valuation on the investment date and take it, or is it preferred to roll over, at a later date? And what is you think in coming days will be more popular?
Yeah, So from structuring point of view, CCPS is the most popular mode of investing and structuring the transaction as well, and continues to remain so, I think, because of various advantages that it gives as an investor. Of course, since we manage other people's money, we really want to be sure that we get certain rights. And given the way the company performs, there is some recourse to our investments that we make, and hence that tends to be the most sort of favored way of investing. Just to take a step back, though, we don't like, if as you rightly said, there will be always situations where you will be negotiating on valuation, negotiating on structuring. What we like to do and has worked out really well for us is sharing the upside, right? Because a lot of times founders come with very high ambitions, and some of those ambitions are good, and we like that because that shows you the drive, and that shows you the hardworking grit, those sort of qualities from the founders. But at the same time, as an investor, you want to hedge your bets to a certain extent and say, look, I believe you will hit it. Let's hope you will hit it. But I'll come in at an entry valuation which is somewhat protected. So give myself a little bit more margin of safety. But if you hit the ball out of the park, whatever profits I make for my investors, I'm going to share an upside with you beyond a certain IRR, right? So those are ways for you to structure as well, where you can bridge the gap between founder expectation and giving margin of safety for an investor as well. Of course, there are multiple other ways of structuring. There's virtually infinite ways of looking at it, but these are the basic sort of rules that we keep in mind as we look to structure a transaction.
Quite good. Vivek, actually, will come to one more. Most of the controversial question what we see in the social media, like a cash burn kind of model or a profitability model, which is quite trending nowadays, even with the public in the layman. So when we see, Zomato coming with an IPO or Flipkart getting an acquisition with Walmart, and we see cash burn model also actually getting some of them getting successful at the end of their juncture, but we see, many other startups falling actually apart, and investors are gone for a toss. And of course, I could say that CX actually, as a CX, if it'll take, then it will be more of a profitability model that you might be preferring. But then, on a general note, if you can make a comment on which all models are good, both or only profitability, or if cash burn also is good, in what sense and what manner? Leave it to you.
Certainly, Sarvesh. So clearly, I am a believer. We come from relatively old school about controlling your destiny in terms of how much money you are making, and not relying on outside capital dilution from time to time, and therefore because markets can always freeze. But the reality is that what we call the cash burn model, which is essentially disrupting, accelerating growth, and channelizing capital through the P&L rather than the balance sheet. Instead of doing capex or working capital, you are essentially, your acquisitions, you are expensing it through the P&L, because that's quick R&D or whatever else it is. So as long as it's easy for us to analyze and convince ourselves that the capital allocation through the P&L is accelerating the growth, and so instead of the company growing 50%, is growing 150%, and that is relatively voluntary. So it's not that. So the quality of growth and the quality of the capital allocated through P&L is, so if you switch it off tomorrow or taper it down, how much will your revenues start degrowing, or will the growth taper down from 150% to 75? That's I would say till 2 years ago, for relatively traditional investors such as us, we would have conveniently said that is a problem for investors like Vikram to solve, and it's there are enough ways for us to make money without getting our heads around it. But today the reality is that when the Indian public market support are able to convince themselves that they also buy that a credible brand is being created like Zomato or Nykaa, and which can compound on a large basis for 10, 15 years, etc., and they apply a multiple to it, then we can no longer ignore it. So the way for us to look at it is that if we, for example, did a buyout, for example, one of our companies hopefully should be going public soon is a platform company called Sapphire Foods, which is a restaurant business where which always made money, but essentially we bought 7 different franchisees and put them together. And when it was private and we owned it fully, we didn't care whether every year you made money. We took hits, we took losses because it was private, and we understood it ourselves really well. So we didn't have to convince anybody else. So now that it's going to go hopefully public, the solution, it's more, the explanation doesn't need to be done to the markets. But if we are investing in New Age, which is a loss-making business through the, or let me say, who's allocating growth capital through the P&L, we have to take the trouble of understanding it, whether it is CAC, at what level is the voluntary spend, really voluntary, etc. So we have to make so there's nothing wrong in this business. We are no longer skeptics. We have to do extra work. The market support it in the US, across the world. And we just have to make a judgment about how quickly the company, if it wanted to slow down, can turn very profitable.
That's quite a fair point and really taken. Coming on to one last thing with Vikram, and then actually I'll just end up with Gautam with something for Novopay, and then we'll move to question and answers because we have many, and actually there's already shortlisting going on. So Vikram, actually there's great confusion on in the startup industry and the advisors guiding them that the timing of fundraising. Now, of course, the timing of fundraising is a minimum viable product when it is developed. And so there are 2 things. One is, when is this minimum viable product really developed or not? That is actually one of the confusing state of mind always with the founders community. So how do you take on that? Second thing is that, how much they should bootstrap. So, is it something they want to bring it post-revenue, or is it something not even post-revenue, but they actually have to really make and grab a good amount of market? So, of course, the amount of bootstrapping will be different from startup to startup, but if you can comment on general on the minimum viable product and what is the stage of business development they should achieve before hitting the market for fundraise, that will be actually, quite great.
So I'll tell you, I have a slightly different way of looking at this. Typically, what's happening now, entrepreneurs are raising funds just because they believe that, fundraising is very glamorous. When the announcement happens, they get a lot of visibility, etc. The larger the funds they raise, the better it is, etc. I think I'm of the view that, one should just concentrate on the business fundamentals and focus on what is the real gap in the business in terms of fundraising, and that's one part. And the second part is that they should think of bringing the right people to the mix, right? So many times when you're making your assumptions that you need so much capital, if you got the right people in the mix, chances are that your assumptions may completely change, because what you're thinking is the expense going to be for marketing, for example, and you realize that somebody who comes and starts mentoring you or guiding you and gives you some ideas where your cost of marketing can substantially come down from what you're actually thinking originally. And similarly, cost of people, what should be the right model in terms of at that stage, fixed cost versus variable cost. Many times entrepreneurs don't think right in terms of the cost structures. So they need the right guidance at early stages, especially. And therefore, even if they're raising some capital from people, they should focus on getting those people, getting capital from those people who can actually bring a lot of this knowledge of how to really create a capital efficient business model, rather than just putting in somehow as much capital and throw money behind the problem solution, right? So therefore, it's extremely important to stay focused on your business fundamentals, stay focused on finding better ways to solve your problems, more capital efficient ways of solving problems, and getting the right people in the mix, who ideally can also bring capital along with them, right? So that if they have capital in the mix, obviously their incentive to add value is much higher. So therefore, bringing the capital which comes with the knowledge, with the network, with the passion to drive value, makes much bigger difference as compared to raising the capital itself. So I think people should focus on getting the right people together rather than just focusing on raising capital. So bootstrapping is all about, this particular aspect of, making sure, getting your business right.
One thing which I noted from your point is quite good, that many times we have seen that, the founders to the industry which their startup is belonging, they don't go to the veterans or investors in that industry. They feel sometimes insecure that they'll actually take their idea or execute their idea. But that is not always right. Other way around, actually, now, as you commented, very correct, that these founders are getting matured. So now, if that is a consumer startup, they'll be going to somebody, some senior in Unilever or Parle or Dabur, and if he is an angel, you'll get investment from them, and then investors, as an institutional investor, you will also be more comfortable if such angel is there and they have guided through or vetted the process for investing into that startup. So of course, I mean, that's quite a point well taken and to be learned by the audience at large, that idea is nowadays in the world of all Google Guru and all, it's a little thing, and it's more contributing to the execution of that idea, which is getting more importance, and that's what we see. So that's quite really well said. Gautam, actually, as Dheeraj was commenting earlier, that for chartered accountants, if Novopay, if you can actually look at how because you are starting some good service of lending partners, or you already have, 120,000 plus retail outlets. So is there actually any good opportunity for small and medium practitioners for chartered accountants in Novopay that you would actually like to discuss around?
Absolutely, Sarvesh. But just before that, I think, Sarvesh, you mentioned about execution, and I think execution is the key. What Vikram also touched upon in terms of how do you stay focused on the business, how do you execute the business. So I just, before I get into the Novopay offerings, I wanted to tell you that, and we follow a framework called OKR. Okay, it's objective and key results. Okay, which is was discovered by Andy Grove of Intel and John Doerr, and then the implementation of that framework in Google made it really quite well known. And that really focuses on, and there's a book from John Doerr called, Measure What Matters, right? And I think that is what, all the budding entrepreneurs or all the people who want to get into entrepreneurs, they need to understand as to what really matters. Okay, what is the problem that I'm solving? And what are the things that I need to be measuring, in order to achieve success? Now, that means what kind of a model you go in, you do a cash burn, you do a, CapEx, and it doesn't matter. But, at the end of the day, if those parameters which matters for the success of the business, if you stay focused on, you can choose your methodology and you can do how you want to achieve that. But staying focused on that execution part is an extremely important point. I think you mentioned that, Sarvesh. And coming to to the chartered accountant community, and this is like an MSME and a forum as well. Okay, so I mean, all of you, of course, know UPI. UPI did 3.5 billion transactions last year. So what it really revolutionized the entire payment landscape of India. Correct. So something similar is happening really right now. Okay, it's called OKEN. Okay, the Open Credit Enablement Network, which is essentially credit or lending based on flow-based lending, which is to the small and medium enterprises, which may not have, which may many a times they may be even new to bank. They're not even taken a formal loan from the banks or so. So we offer, so what we have done is that we have created SME, a neobank for the SMEs and MSMEs, okay, as well as the OKEN. We are a LSP and a TSP. LSP stands for Loan Service Provider, and TSP stands for Technology Service Provider. These are standard terms that iSpirit team has come up with. Okay, it's part of the India Stack offering. So we are a provider of the OKEN-based services, which essentially allows real-time lending or loan decisions to be taken for MSME and SMEs. So those who are SMEs, they can leverage this particular network. They can come through us as well. Okay, and also the chartered accountant community, they can partner with us, and they can act as the originators or people who can recommend such loans to them and bring these loans and the payment services to the SME and MSMEs that they must be. I mean, many of the chartered accountants manage those accounts. The entire financial functions are managed by the chartered accountants, and they can therefore get the best deal for some of them. So these are completely technology-enabled product. Happens on a paperless way, instant decision making, and this is something that can that has the potential of disrupting the lending space. Okay, and as UPI has done for the payment space. So that is something that you guys can check us out in our website, novopaybanking.com.
Great. Really, thanks for that and sharing that opportunity. And moving on to on the paucity of time, we'll just move on to the question answers. And there are actually questions compiled. I'll just read one by one and address it. And any of the honored panelists, if you guys actually want to contribute, supplement, just feel free to add on anything. So just let me start over. So what is the suggestion for a small scale entrepreneur to grow with the aid of venture capital investment or other suitable mode? Usually as per my opinion, a small, there's nothing micro or small or large. What I have said that the cup of tea for raising a private equity or venture capital can only be there when you have the scale. If your business is stable, if your business is even growing, every business is not an investable business that could be a cup of tea for equity raising. And if a business is stable or traditional and going at a traditional speed, then actually that is the best alternative. In equity, you need, of course, a highly scalable kind of business. So chartered accountants or investment bankers, advisors should see any business houses approaching them that many times actually, I mean, even if the business is having a scale of say 500 crores currently, but then if it is just going at a scale of, as what Vivek was telling, that at least actually 20-30% scale, it should be growing. If it is stable, stagnant, then it will be not a cup of tea for raising equity. So that is actually my point on this. Please suggest a good VC for a small scale snack manufacturer and seller to augment his turnover from 200 lakhs to 500 lakhs potential in Tamil Nadu. So of course, first of all, I feel that investors and funds are not, most of the funds are geography agnostic. They invest anywhere in India. And second thing is, of course, you'll have to look if it is a consumer based. You'll have to study that the fund, I mean, every fund is having a philosophy, sector specific. Some do consumer, some don't do consumer, some do tech based, some do direct to consumer. So you'll have to study the kind of, the funds and what is their philosophy, and basis that you'll have to approach, or actually either route it through a experienced investment banker. And then there are actually questions on what does startup capital funds need and what are the guidelines. So as we have discussed in this panel, you would have noticed that there's no guidelines, and it's more of like open-ended, and you'll have to think that whether your business is scalable and is it making a sense in the competitive world. And that is the whole thing. You'll have to make it convinced to yourself, then to the funds. So I think that is something. Can you brief us on convertible notes? Also share name of companies who raised funds through convertible notes. So, anybody from Vivek, Nitin, or Vikram, actually, if you can just give a little glimpse about convertible notes as an instrument for raising funds, and how far that is popular among in the equity fundraising.
I can go. So my view is a little. So while convertible preference shares and convertible notes are quite common and have been done, I would give a counter viewpoint to Nitin's in my philosophy, though we've done it in the past, is that what essentially you are doing is if you expect the valuation to increase significantly in the future, so you're deferring the problem of negotiation today to 1 year out, 2 years out, 3 years out, or even exit, saying if we make a certain return, then above that we'll share, or we'll convert at the next round as a discount to it. And that's a credible model. But what it inherently does, this particular thing, is it creates a inbuilt conflict with the management team. So if the convertible note is open for 1 year or 18 months at the very maximum, I think it's a good idea because it's an interim fundraise to the next raise. And there are several investors who don't want to take the hassle of negotiating price, etc. At this point in time, they'll rather come at a discount to But if it's anything more than that, all you're doing is, all of us are human, and we will have conflict at the time of exit or etc.
That's good. Again, actually, a question for
just
Vivek.
to add, Sarvesh, I think this is probably a better construct for a follow-on round where some sort of baseline valuation is established, right? So probably not the ideal construct for the first-time transaction, but as a follow-on round, if it's similar sort of investors or some sort of friendly funds, then this constructs work better, right? But ideally, don't worry about structuring as much at this point, right? If you're starting out as a startup or an MSME, those things can be resolved over time. The key is to find the right investor and the right strategy for the business growth.
Correct. So see, I mean, there's a question for you, Vivek. How does PE look at valuation for EPC renewables? So I'm putting my thoughts that, first of all, is it renewable energy, maybe an IPP business, independent power producer, or EPC business is something which CX partners look at? And if yes or no, then how do you really, they are asking that valuation build around the EPC renewable business?
Specifically, I'm not equipped to answer that. So we don't do renewable as a fund, and I don't specialize in that. But it's a problem easy to solve. So they just need a good experienced banker to advise them and look at the peers and look at the way to look at valuation is basically where you get a good advisor and where is your book getting built, where are you getting investor interest, which is very with reasonable competitive intensity. There is some negotiation, but it's getting done. If your expectation is very high and your book is barely getting built, or it's getting built only in a bull market, that's not a good financing strategy. But if you've got a good balance and you getting a book of 1.5 to 2x of what you want in terms of the capital you want, that's a good price.
Correct. So I mean, such kind of any EPC business is depending on the order book. Maybe it's road concession or maybe it's EPC, the order book. And second thing, what I would say is the risk on the receivables, because in India, most of the infra companies have gone for a toss because they have not realized their debtors. So that's I think a better way to put it. And you said it correct. I mean, this question, I just blown with laugh with this question. But does having a chartered accountant as an independent director on board helps in a better fundraising? So how would you rate chartered accountants?
I'm a big fan of chartered accountants. So in currently of our 4 active buyouts, CEOs of 2 of the 4 are chartered accountants.
That's great.
So I'll say yes, of course it helps.
Yeah, so that's good. So I mean, at least from the auditing and the compliance, and maybe right from filing the GST returns or anything, in some sense, actually, it definitely adds value to the whole startup. And how we as a chartered accountant can be value adders to the startup ecosystem. What do the VC or PE funds expect from CA fraternity in this backdrop? So, Vikram, again, you are actually, as Dheeraj told at inception, you have been incubating a lot, with IIT Delhi, and it's great. I mean, I would like to tell to this forum that the work which IVCAP Ventures, they have actually launched IV Camp also for smaller ticket size investments, and they are the one of its kind and first, incubation the first mentor fund, what we tell, and the most active and most effective fund, what is being launched in collaboration with IIT Delhi, and now other IITs are also getting collaborated. And then Vikram had really done a great job around that. So, Vikram, something on that, and on similar grounds, how do you see CA fraternity contributing to this ecosystem?
So just like Vivek mentioned, I'm also a great fan of the CA fraternity. And I think CAs have a big role to play. And I think now, I'm seeing a lot of CA collectively coming together, even on the angel side, which is a great thing actually for startups. And one of the biggest missing links at that stage, especially at early stages, is that, how to manage your finances, how to structure yourself, very basic things that they do not necessarily understand at very early stages. And I think CAs have a major role to play there to mentor, to guide them, basically also at very early stages partner with them. And now, of course, with a lot of regulatory requirements happening in terms of, if you're an NBFC, a particular CA firm can only have so many firms that they can audit, etc. There are obviously guidelines which are actually encouraging more and more CA firms to flourish. I think I would say that it's a good opportunity overall, and also from the perspective of the business of the CA or the CA industry itself. I think this timing is such that I think it should be leveraged very well. So, and collaboratively work with people like us, people like Nitin, Vivek, and others, where obviously the opportunities can be many. So that's the way I would put it.
So there is actually a question with the business that have yet to kick off on a full-fledged basis or have just started. How one can value such businesses? Again, actually, it's again will need an entire session to address that. I know, because valuation is something quite tricky. But then again, being a first institutional fund, if you can just address that valuation thing.
It's a tough question, to be honest with you, and I think valuation is a function of not the value. Many times people confuse it in terms of putting a number to it, right? So I think it's a function of who's bringing how much value to the equation, right? So I think at that stage, even when the team is actually negotiating with each other, right? So there are 3-4 people, and then the question comes, why should the stake be equal? Or why should one person not get more than the others? Lots of those questions come up, and there are various factors that come into equation. There's a risk each individual is taking. There's an opportunity cost of that individual. Many times somebody says that, okay, I'll give you 50% of my time, but I need X% stake. I think all those things one need to consider, that how much risk, how much time they're putting in, what is the experience and the value they're bringing in. And therefore the structuring of the team stakes itself is very important. When the investor is coming on board, right? So then there's a question of, this sweat equity on one side and the financial equity on the other, right? So how do you really combine the two and, address that point? And there are various models there depending on the kind of a business itself. Is it a product business, services business? Is it a very high risk business? Are there examples out there? So multiple things go into it, but I think a typical rate, there's a ratio. It could be 60-40, 70-30, sometimes 50-50 in terms of sweat versus cash. And that I'm talking very early stages, right? So when people are still conceptualizing the model. But there's no right or wrong answer here. It's a matter of what.
And actually, before approaching the funds, it is between the founders also, because some is cash rich and some is sweat rich. So, you'll have to figure out a valuation at that point in time also, and then that is something basis your understanding between the founders, and then later we approach. Then there are actually, I think they could see other competitive startups also who have raised a fund at that level.
But I think, just to complete my thought on this, and it's an important one, many times, because you don't know the answer, what you do is you make assumptions and you make corrections over a period of time. So it's important, and that's the reason you sometimes get these bridge rounds which are not valuing the companies. You actually always value it as a discount to the next round, and you do a similar kind of a thing when you're structuring your early rounds. If you can't value it, just leave it. Just kind of do some structuring so that it gets corrected on its own.
So I have a similar experience because there is actually a direct competitor of Blackbuck. Blackbuck recently got into unicorn, and when they approached me, actually the angels of the bridge round have been blown away too much, and they don't allow them to get an institutional investor at that point in time, and that actually really not made them to scale up that well. So as you said, actually, angels, you'll have to be cautious enough that you really don't blow away the valuation, and then later they are not allowing you to get the institutions in place when institutions were doing a fair valuation. So I think that's quite deep, but quite a good learning. Last thing is then actually I think we'll hand over the session to Dheeraj. How can a practicing individual help the startups connect the VC and the other funds? So of course, as an investment banker, I could comment that there is no central repository of the funds, and funds really have a small team and many times a bigger volume of funds as well as the startups to handle. So they are actually also quite busy. So it's of course a great way to either pitch them directly, if, as Vikram told, that if you are matured enough to do that, or then actually either if you are not and if you don't have experience, then hiring actually an interim CFO. Because what we see in US, interim CFO hiring is quite common, and chartered accountants really have that opportunity also, that many times that particular startup cannot afford a full-time CFO, but then whosoever is experienced in raising funds, they can hire an interim CFO who will guide them and make them ready for fundraise. Or either actually they can hire a good investment banker who is well connected and can help them out. So I think this is what I can place. So I think we are on time, Dheeraj, and if you are there, and before handing it over to you, I mean, with each of the honored panelists, I'm really quite grateful that not from the heart, but not from the head just, but you have really addressed the panel from the bottom of your heart, that we can realize with whatever thoughts you guys were contributing, and anything if you want in any ways to put across the forum, which I might have missed, or we are happy to take that.
Thank you, Sarvesh. It's been a pleasure, and your questions and your way of handling has been also very good. So thank you for hosting us.
Yeah, likewise. Thank you so much.
Thanks, Sarvesh.
Thank you very much. Very appreciated. Yeah, very well conducted.
So I think most of the panelists has been very vocal for local, as well as the advocating about the professional people to handle the private equity and funding requirement to the any MSME and as well as the startup, and very well taken by the surveys for how the pitch to be prepared, how to pitch that, and what the risk elements to be taken care of it. Valuations part also play in these roles, and of course management part of it. So all its combo, it's all together. It's not only just a complete product. So it's all complete entire packaging product of end to end. Then only the venture capitalist or private equity look for funding. So I think it's a great session. It's a complete knowledge about the funding part from the start to end. I think there's great panels. So thank you, Vivek, Vivekji, Vikramji, Gautamji, Nitin ji, and as well as the service for excellent session. I think this is one of the wonderful session, and we are getting a lot of messages as well as the mails on the webcast. It's been wonderful. A lot of queries still around, but definitely we'll address them later on. We'll post it while taking your consideration. So with this, I think very thankful to each and everyone for taking your time to the startup this concern. So very thank you very much, and wishing you all the entrepreneurs happy entrepreneurship.
Thank you very much, Dheerajji.
Thank you very much.
Wish the learned audience also quite an engaging audience with quite thoughtful questions coming up, and really my pleasure for the appreciation, and it has been a really wonderful time invested.
Thank you. Thank you.
Thank you.
Thank you. Bye-bye.